Most people believe that money is something the government prints. They imagine stacks of green bills in vaults, guarded and stored, waiting to be handed out as salaries, government spending, or loans. They picture money as physical, tangible, real. But in reality, physical cash makes up less than 10% of all money in the United States. That's right, the vast majority of money is digital. It exists only as numbers in databases, ledger entries in bank systems, and balances in accounts. When you check your bank account and see your balance, that number wasn't printed yesterday. It was created, typed into existence, by an institution you trust. And the more you rely on money, the less you understand how it's actually made. Consider this: if most money is created digitally, who decides when it exists? Who types it into reality? The answer isn't the US Treasury, it isn't a single institution, and it's not arbitrary. It is a system, a network, a set of rules that most people never learn, yet it shapes nearly every decision you make, from buying a home to investing in stocks, to retirement planning, and even your daily groceries. Understanding this system is not optional if you want to control your financial future. By the end of this video, you will understand how commercial banks create money, how the Federal Reserve influences the economy, why inflation is not random, and why most Americans unknowingly pay the cost. This is the economic code, and today we decode how money is really created. Let's start with the story most people tell themselves about money. It begins in grade school. The government prints money, banks lend out deposits, and the economy functions like a giant, predictable machine. This is comforting, but it's not accurate. In the United States, there is roughly $23 trillion in money supply, but only around $2 trillion of that exists as physical cash. The rest is digital, numbers in accounts, balances on screens, transactions that happen in milliseconds. Take your salary as an example. When your employer pays you, the money doesn't come from a vault full of cash. It comes from digital bookkeeping entries. The same is true for credit cards, mortgages, and loans. Think about it. When you swipe your credit card for $100, where does that money come from? Not from your bank account directly. The bank effectively creates that money for you for the transaction. Later, the balance adjusts, but the point is, money is generated through accounting. This system creates a false sense of scarcity. People believe money is limited, when in reality it is mostly a product of trust and accounting rules. But here's where it gets more interesting. The money created does not enter the economy evenly. It flows first to certain groups, asset owners, corporations, investors, before reaching the broader population. Understanding this flow is critical to understanding why wealth inequality exists and why some Americans feel like the system is rigged. And the mechanics of money creation are even stranger than most realize. The next section will show you exactly how. Most people imagine money like this. The government prints cash. The money is deposited in banks. Banks lend out deposits to borrowers. This is how it works in theory, but in modern banking, it is almost entirely backwards. Banks do not lend out deposits in the way you think. Instead, when a bank issues a loan, it creates new money. The loan does not come from someone else's deposit. It comes from nowhere, and then becomes an asset and a liability on the bank's balance sheet. Example, you apply for a $300,000 mortgage. Most people imagine the bank checks its vault or reallocates existing money from deposits. That's not the case. Instead, the bank types $300,000 into your account digitally. The moment it does, the money exists. This system is called fractional reserve banking, but the term doesn't tell the full story. Modern banks are constrained by regulations, capital requirements, and risk management. But the majority of money creation happens through lending, not printing. Think about that. Every time a bank issues a mortgage, an auto loan, or a credit card, it is creating money out of nothing. And here's the critical insight. Debt is money. Without debt, the modern money supply collapses. Without new loans, there is no growth in currency circulation. This is not theory. It's documented in Federal Reserve reports, banking textbooks, and financial studies. Yet most Americans never learn it. Let's go deeper. Modern banking systems are complex, but the mechanics are consistent. When a bank issues a loan, the bank records a new asset, the borrower's loan obligation. Simultaneously, it creates a new liability, the deposit in the borrower's account. This dual entry accounting is what generates new money. Example, if Bank of America gives a business a $1 million loan, that $1 million did not exist before the loan. Once the loan is approved, the deposit is added to the borrower's account. This money enters the economy immediately, flowing through payroll, supplier payments, and investments. Banks are not creating money illegally. This is legal, regulated, and foundational to the US economy. Constraints exist. Banks must maintain capital ratios set by regulators like the Federal Reserve. They must manage default risks, and lending decisions are influenced by monetary policy. But the takeaway is clear: money is created by banks when they lend, not by the Treasury printing cash. Over time, this explains why mortgage-backed assets, consumer credit, and corporate debt dominate the money supply. Debt creates liquidity, liquidity drives spending, and spending fuels growth. This also explains why economic crises happen. When loans are repaid faster than new loans are issued, money supply contracts. Businesses struggle, jobs vanish, financial markets react. The Federal Reserve does not directly create consumer money. Instead, it influences the conditions under which banks create money. Tools the Fed uses: interest rates. Low rates encourage borrowing, high rates discourage it. Open market operations. Buying or selling government bonds adjusts liquidity. Reserve requirements dictate how much capital banks must hold. Example, during the 2008 financial crisis, the Fed lowered interest rates nearly to zero. This encouraged banks to lend more and stabilize the economy. The Fed sets the stage, but commercial banks are the actors creating money in real time. Understanding this distinction is critical. The Federal Reserve influences money supply indirectly, but the actual creation happens at the commercial bank level. Power is decentralized, influence is networked, control is subtle. Money creation affects prices, but not immediately. This is where most Americans feel the impact first. Inflation occurs when the supply of money grows faster than goods and services. But inflation is not neutral. The new money enters specific channels first. Financial markets, real estate, large corporations. These groups benefit from new money before wages and everyday prices adjust. This is known as the Cantillon effect. If you own assets, you profit. If you live paycheck to paycheck, you feel the squeeze. Example, between 2020 to 2022, the US money supply increased by nearly 25% due to pandemic stimulus. Stock markets and real estate surged, while wage growth lagged behind. This illustrates the invisible transfer of wealth in action. The winners, banks' asset owners. Corporations with access to cheap capital, governments funding deficits. The losers, workers dependent solely on wages. Those without appreciating assets. The system is not evil. It is structured. It rewards leverage, ownership, and proximity to capital. Understanding this is not cynicism. It is insight. So what does this mean for you? Money is more than currency. It is a system of trust, credit, and debt. Understanding this system changes how you invest, save, manage risk. Think about wealth. Most people work for money. Few understand the code behind it. Once you see the system, you cannot unsee it. This is the economic code. If you want to understand the systems shaping your financial future, like, comment, and subscribe. We release new investigations twice every week. Dive deeper, question everything, decode the system.